Welcome to the first quarter of the 2026 market updates. We're very happy to bring this to you. It's titled The Wide Divergence Between Perception and Reality. It's not a magic show, but Himalaya is going to be talking to us what's going on in the markets, and we've got Sarah Jones, who's going to be asking some really tough questions, and Noah Djurfeldt, who will also be chiming in there. So I look forward to listening to the three of them. Anyways, it's already February 11th, which is amazing that it's gone by this quick and the market's gone up. I don't know if anybody's seen the activity, but the market is very volatile right now, and I think Himalaya is going to explain, what's going on. I want you to actually just curl up right now, put your blanket on, start the fire, a little warm cocoa, because it's so cold out, and I don't know when that's going to warm up, but at least we've got something here that we can think about, and I'm going to pass it over to, is it Noah and Sarah, and then they can start talking with Himalaya. So over to you guys.
Thank you, Gord. I will kick it off so I can ask the first hard question. I'm thrilled to be back on camera and welcome everybody who's watching and listening to 2026, our first market outlook. I'm very pleased to be with Himalaya and with Noah, and I will control the questions. So you guys send me your hardest questions, and we'll see if we can't make them stumble. It is a competition. So as Gord said, Himalaya has put together a magic show for us. The divergence between perception and reality. And the way I'm looking at that, or the way I feel that, and the way the conversations that I've had with clients have gone, is there just seems to be so much negativity in the news, in the headlines, from sentiment out there. And for those of us in Ontario, let's face it, it's the weather. That's been a real drag. It's been cold since I can't remember when. And I think from what I understand, even in Florida, you guys down in Florida are suffering a bit in the cold. But when you have a look at your account statements, you must feel pretty good. I do when I look at when we're doing client reviews. So Himalaya, can you maybe delve into the divergence between the two?
Sure, Sarah, thanks. I can't remember a time in my many, many years where there has been such a divergence between what people are feeling versus what's going on in the market. And that's, perhaps one of the top questions that we get is, what's causing this? Like, shouldn't the market be a lot lower because of all these risks, whether they be geopolitical or, potential risks to the economy? So when we dug deeper into it, the conclusion that we came is it's not that the risks are not relevant. It's just that they are not that they are just risks. They haven't hit the economy. They haven't hit corporate earnings, at the index level. And what really is driving the market are the fundamentals. The earnings story continues to be very strong. The economic outlook, believe it or not, is still calling for reasonable growth. We're not hitting home runs when it comes to GDP growth, but the economy is progressing at a very stable rate. And again, it's those earnings that are driving the market to new highs. And already this year we've hit several new highs when it comes to various stock indices.
And Himalaya, is that true both in the U.S. and in Canada? We know the U.S. tends to dominate headlines, but it is the same true from a market perspective, both in Canada and in the U.S. And do we as Canadian consumers or everyday people, are we feeling the same effects as they are in the States?
So the first part of your question, yes. In fact, global indices are hitting new highs. So whether it's emerging markets, whether it's developed markets in Europe or the Far East, Canada, the U.S. is interesting because we tend to divide the U.S. into a lot of sub indices or different types of indices. So the Dow Jones, that many of you are familiar with, which is only 30 companies. Some of them are legacy industry companies. That is, I think the last data I saw was that it hit 13 new all-time highs already this year. Whereas the S&P 500 has perhaps only hit less than 5, and the Nasdaq is actually struggling. So it's not such a homogeneous situation, and never is. But we are sitting here at very nice levels when it comes to the stock market.
And Noah, I know as I sit right beside you, I hear you have lots of conversations with clients, and when you're explaining to them perhaps the difference in what they're feeling from what they're seeing on the news or reading in the papers and the performance of the different indices, can you explain to our listeners how those different indices measure and how they've been affected by the change, rollover, if you will, in performance?
Yeah, certainly. And it's a really good question, and one we get all the time. It's funny going back to 2020 and COVID. It was so long ago now, but I think we can all remember how much life changed and really shifted to be more online from social media and news. And now we're bombarded constantly throughout the day with headlines, not just from our local or national environment, but globally. So we could, if we want to, turn on the news and see bad news from all over the world. And that really does affect how we feel in our day-to-day lives and how we feel about the markets. And as you said earlier, Sarah, winter certainly doesn't help that. It's trying to keep a happy attitude when it's this cold outside is certainly a feat. So it's always important for us to keep in mind our own emotions when we're looking at this information. And sometimes just that negative sentiment that we feel has more of an impact on how we're perceiving the markets than we actually realize. So that's when we go back to some of the stuff that Himalaya was talking about, the underlying economic data, the underlying earnings of these companies, to really figure out what's going on. And that's how at Rosedale Family Office, we try to do our best for our clients, is by removing our own emotion and our clients' emotion as much as possible, and really just presenting them the data so they can make really informed investment decisions based off of what these companies are actually doing. And like Himalaya said, these companies, not just in the US and Canada, but globally, are actually doing really well. And that can be surprising to some people when they hear that for the first time. And we'll talk through a little bit as to why that might be happening. But the underlying performance is still really robust. And that should mean, all else being equal, that it'll be a good year in investments. Now, there'll be ups and downs and volatility like there always is. But if you look back historically, if you can buy companies at some of the earnings growth multiples that we're seeing, the forward return tends to be pretty attractive.
Yeah, and if I can just add to Noah's comments, if on the one side fundamentals are looking very sound, we've actually, being curious people that we are, we've dug into the sentiment side. Well, what is driving that poor sentiment? And because traditionally, the relationship goes, when consumer sentiment is positive, that is good for consumer spending. It means it's good for GDP growth, and it's good for then corporate earnings. What we've seen is this divergence that started about 12 months ago, and there's no coincidence that it's been 12 months, where consumer sentiment has continued to decline, and yet corporate earnings, GDP growth, and of course the stock market have gone the other direction. So this divergence, it's not common. And it does beg the question, what's driving that divergence? And when we dug into it, it's not that the stock market is getting it wrong, but on the sentiment side, there are some factors driving it, and they're not economic factors. They tend to be more political factors. So when we dug into confidence, particularly in the US, where they have very granular information, we saw a very disparate sentiment between Republicans and Democrats. So they're facing the same economy, but because of the political environment, their views, their sentiments are radically different. So this is again a period of extreme polarization, that's maybe influencing the sentiment data, but it's not affecting how people are behaving when it comes to spending their money and driving the economy and ultimately the stock market.
Yeah, Himalaya, maybe you can talk a little bit more about that, because I do think, at least in a lot of the conversations that I have, I'll say that to clients and they understand it. They understand the sentiment, but they also see some of the real policy changes and real things that are happening, and they don't understand how it's not impacting the economy. So they're worried that maybe there's just a delay or the other shoe hasn't dropped or something like that when they see the tariffs and things like this that are real policy changes that are coming in. So how do we think about that, and how is it or is it not affecting the underlying fundamentals?
Yeah, it's a good point, Noah. There's in economic data, there's always lags between when there's policy changes or things like interest rates to when it actually affects the economy. So, one very visible piece of data to see how the economy is faring in almost in real time is the unemployment rate. So when you think about here in Canada, we actually hit a peak of 7.1% unemployment rate, which is a multi-year high. But since then, we've actually come down into the mid 6% range. So it tells us that things aren't getting any worse. They're not, it's not booming as it was, say, in 2023 or 2022 or 2021 when the unemployment rate was far lower. But a declining unemployment rate is a sign that the economy is actually performing better. Same thing in the U.S. The unemployment rate there, it just came out this morning for the month of January, and it's at 4.3%, which when you look at it on a historical context, it's still very, very low compared to what we would consider normal even. So it's a very strong economy. So as far as the lags, the tariff situation, there's a lot of noise as to how much tariffs are actually filtering through into end prices. But if you just look at consumer price index in the US or even here in Canada or globally, inflation's actually decelerating. So that doesn't mean that prices are falling. They're just not rising as fast as they have been over the past several years. So that tariff driver, it's not hitting consumer prices. And then while I'm on the topic of inflation, we actually think that as the year progresses, inflation may actually start to come down towards the second half of the year, which is favorable to the economy in general. It's favorable for interest rates, and that's also a supporter for the equity market.
Yeah, one other thing I like to bring up to clients that I don't think they sometimes realize, because people often see the top line index performance, the S&P 500, and they see that it's doing really well. And they're a little bit worried that maybe the market's asleep at the wheel and not pricing in some of the risks from the policy side. But if you look at it at a sector by sector basis and dig in a little bit deeper, the market's actually been doing a pretty good job of pricing in some of those risks. So if you think about what companies are really impacted by the tariffs, whether they're retail or automotive in North America, those companies have actually performed fairly poorly over the last 12 months because of some of those risks. We just don't see that when you look at top line index numbers, because the major companies in North America today are not what they were in the 80s and 90s. It's much more service based, much more technology based, which is really not impacted by many of the policy changes. So I do think once you see that, you start to realize that markets are actually working fairly well here, and a lot of that worry that things aren't being priced in properly, I think is not really fair when you actually look at which companies are doing well and which companies aren't.
Yeah, good point, Noah.
Yeah, very interesting. Now, I think going hand in hand with what you both are saying, we can't not talk about AI and how that's going to affect productivity, unemployment. Himalaya, can you elaborate a bit on that?
Yeah, so we're at the very early stages when it comes to AI development, adoption, consequences, winners, losers. I like to think about this analogy of the way railroads rolled out in the 1800s. The initial attention, the investment, the profits, the stock market darlings. Initially, they were the people that were building the railroads. That lasted for a few years. And then eventually, it was the people that were using the railroads. That's who really benefited, rather than the ones that were actually, were laying down the rails. So similarly with AI, what we're seeing now is a transition from the builders of AI, whether they be the chip makers or the data center companies, which have tended to be the Mag 7 type of stocks. We're seeing a transition over the past few months to the users. And that's why you've seen this rotation that's been happening within the marketplace where Mag 7 stocks have stalled for the time being. And yet you've seen a lot of other sectors do very well. And a lot of that is because of AI. When we look at what is projected as far as margins, margins are expected to expand when we look at 2026 estimates, 2027 estimates. So that's evidence to us that AI adoption has started. The benefits are starting to accrue to a different subset of companies. And again, that is, it's following a very similar pattern. But again, it's early days as to who, the clear winners and losers will be. But the economic consequences are that we can continue to expect GDP growth, even though we might not see a lot of job growth. So I was talking earlier about jobs and how the unemployment rate's actually been coming down. But when we look out, it doesn't mean that the economy is going to stall out because of AI. AI should lead to productivity gains, and that means that GDP growth will continue to grow. So, so far it's following us a very predictable pattern as to, who's going to benefit from AI.
Yeah, I guess the other thing that we've seen recently, Himalaya, and by recently I just mean in the last few weeks, is much more concern in the marketplace about AI displacing certain industries and companies. And it's been pretty remarkable, actually. It's like if anybody's as much of a Tolkien nerd as Himalaya and I, the Eye of Sauron kind of casting its gaze across the market. And it settled on SaaS last week, and the software market was down significantly. And it settled on banking and insurance this week, and those companies were down significantly. And that's all just on the expectation, or maybe the fear is a better word, of AI displacing and replacing some of these industries. And in some cases that may be true. In some cases, maybe most cases, we actually think that's very overblown. But how are you seeing that displacement dynamic start to play out?
Yeah, so you're right. So under the hood, even though the market itself, the index itself is performing well, under the hood, there's a lot of churn happening. And, rightly or wrongly, the market is, it's casting its verdict as to who the winners and losers are going to be. So Noah, you mentioned SaaS, that stands for software as a service companies. So think about companies like Salesforce, or companies like Oracle, where it's not a product, it's a piece of software that they are selling to users. So it's those type of companies that have for years and years built their models on selling software and adding features, raising prices, and it's a very high margin business. And those companies have tended to trade at a very high valuation because of that business model. Not a lot of capital required, very high margins. That is what's being disrupted right now. The interesting thing is that there's actually no actual disruptions happening to their current earnings. Their stock prices are declining because the market is saying, well, today is okay, but maybe in the future, your sales aren't going to grow as fast as they used to, or you may have to invest more heavily than you have in the past. So there is a lot of what I call shoot first, ask questions later happening right now. Whether businesses are actually going to get materially disrupted or not, That's to be seen. But that, again, there's a lot of that's what's causing a lot of volatility. And sometimes, you'll see a stock or sector or a subsector decline materially because of AI fears. Again, that is the way the market is adjusting based on expectations of those winners and losers. So again, that's happening below the surface of the market. As a whole, the market continues to move higher because, again, it's looking at a very small subset of companies that might get disrupted, but then there's this much larger subset of the market that will actually be a beneficiary of AI in the form of higher margins going forward.
Yeah, I think that's a really good point, Himalaya, and kind of goes back to what we were saying earlier about the market doing its job. Like, some people forget that ultimately, like, the market is supposed to be allocating capital between different companies and deciding where capital should best flow. And it's good to see that it's actually doing its job in distributing that sort of performance and capital properly to the industries and the companies that are indeed doing a good job. Because that's always the fear when you hear about a bubble, that capital misallocation is starting to happen. And so I think for us and for a lot of our clients, it's very reassuring to see that the market is actually being discriminatory between which companies are doing well and which aren't, and which ones are going to continue to do well in the future.
Yeah, that's exactly right, Noah. The market is doing its job when it comes to looking at who's going to benefit and who potentially might get hurt.
Well, Noah, you mentioned the word bubble, and that is another topic or phrase that I've heard a lot from clients. Are we in a bubble? Is this a bubble? What happens if the bubble bursts? And I'll come back to that because I think that is a great topic that we can flush out a little bit on how we are designing our portfolios and setting people up to weather a more volatile market. But before we get to that, let's go to the other conversation that we have a lot these days, and that, of course, is gold.
Well, speaking of potential bubbles, no, jokes aside, yeah, so gold, it's been very interesting. When you look at a chart going back 20 years, 30 years, 50 years, it has been a gradual upward sloping chart. However, in the past 12 months, we've seen quite a bit of appreciation. And so gold has always been seen as a store of value. It's a hedge against risks. But what's driven it in the past 12 months or so, I'd say, is this concern about the US dollar. It's been concern about US trade policy, the overreach maybe that some people are seeing of the US administration. So what initially started as other central banks wanting to diversify their foreign reserves, away from just the US dollar and maybe holding a wider basket of reserves, whether it's other currencies or increasing their gold holdings. That started the upward movement in gold. But what we've seen with gold and especially with silver in the past, call it 4 to 6 weeks, it was a very speculative market. So whenever markets start to go, from a gradual uptrend to a parabolic move, and you start to hear anecdotal stories and I actually heard one not too long ago, that there's a barber somewhere in Arizona actually selling silver out the back door. And when you start to see that and places like China, where there's lineups around the block of people wanting to buy physical silver or buy gold, or they're leveraging themselves using derivatives or simply borrowing money to ride the wave. That's when you start to think that, okay, things are getting a little bit too hot, or we're entering that speculative phase. But when it comes back to gold, the long-term trend is, I think, intact. Maybe we're a little bit ahead of ourselves, on the absolute price, but there's nothing to say that 5 years from now, 10 years from now, that gold wouldn't be higher than it is today.
Thank you very much, Himalaya. Noah, I'm going to ask you to maybe describe some of the changes that we've made in our portfolio, and Himalaya, of course, you chime in on this as well. Ways that we are perhaps moving away from the Mag 7 type of large cap stocks. What are we moving into, and how are we positioning portfolios to be resilient and stay away from those potentially frothy sectors?
Yeah, it's a really good question, Sarah, and there's a lot that goes into it, and it is on a client by client basis. So I'm going to make some general comments, but your specific portfolio might look different depending on your own goals and strategies. But in general, we did make quite a few changes last year to how we invest client dollars. And a lot of that was in response to some of the policy changes in the US and some of the changing market dynamics globally. So we made the move last year to move away in large part from more individual holdings into more broad ETFs and funds and things that give us more diversification across entire sectors or entire countries in different asset classes. And we did that because we were really trying to avoid specific name risk, especially in light of some of the policy risk happening in the US, where the administration down there might come out one day and mandate a tariff in a specific sector or against a specific company, or carve out trade policies for specific companies. We wanted to avoid any specific name risk to the degree that was possible. And so we pulled back a little bit on our individual holdings and are now really looking more at broad market ETFs and more diversified baskets of stocks. And that's worked out very well for our clients over the last 12 months. As Himalaya was talking about, there's been a lot of froth in individual sectors and individual names, but broad markets have done really well, and we and our clients have been the beneficiaries of that. Coming more into this year, into 2026, we were really putting an eye towards managing volatility and helping our clients make money, even if there were some ups and downs in the markets. And so we've been looking a little bit outside of the normal cookie cutter box of stocks and bonds, more into the alternative universe to find some really interesting opportunities in the hedge fund space, specifically with long short strategies. It sounds more complex than it is. Basically, these companies try to completely neutralize any market movement that might happen and just make money from some of the appreciation of really good companies over time. So they don't care if the market's going up or the market's going down. They try to make money week in and week out just from the fundamental performance of really good companies. And we actually started a partnership with Goldman Sachs down in the US to get access to one of their market neutral funds that has performed really well for their institutional clients historically. And we were able to convince them to come up and let our clients invest in it in Canada. So that's been a really interesting new addition to many portfolios. But for most of our clients broadly, we are looking for ways to diversify outside of just specific stocks and bonds into things that will perform really well for you, even in a volatile market like this year.
Yeah, that's a good way of positioning it, Noah. And I'll give you an example of something a bit more like we've been moving, as Noah said, in that direction. We're also focusing on some themes. So, an example of a thematic investment is, you've probably all heard about, the massive build out in data centers, mostly in the US, but it is actually a global phenomenon where these data centers that power AI are being built, and their huge appetite for electricity. So there is a shortage of electricity that is being projected, and the expectation is that we're going to need a lot more electricity production. So we've invested in an ETF that essentially holds as a basket all of those companies that help build out the electricity grid. And in fact, the ETF, the symbol is actually called GRID. So it's actually not electricity producers. It's the people that that are supplying power plants, whether it's a generator or It's companies that put up the wiring and all the infrastructure needed to not just generate more electricity, but to transport it to where it needs to get to. So it's in addition to moving to some broader market exposure, but also some thematic investments to capture some of these cycles that may continue for the next several years.
Well, this tailing off of thematic investments, also tying into the talk about all these new possibilities, capabilities. That draws my thinking, I guess, to small cap, smaller companies. I know that we have made an allocation in the past in our portfolios. That's something that we're continuing to look at and perhaps build on. Is that right?
Yeah, I'm glad you brought that up, Sarah. So think of small caps as, again, another way to read the tea leaves of what the market is feeling. So small caps, when you look at a long-term performance chart, small caps typically underperform large cap stocks. However, there are times during cycles where small caps outperform. Typically, the relationship is when small cap companies are doing well, they're doing well because the outlook on the economy is positive. Small cap companies don't have very strong balance sheets as large cap companies do. They don't necessarily have the access to capital. So for them to outperform in the marketplace, it's a vote of confidence that their underlying businesses have a very strong outlook. So that's what we've seen. Again, that rotation I was talking about that began a few months ago, that's actually been lifting small cap stocks as well. And we do have some small cap exposure in the portfolio, and we're constantly looking at, the weightings. Are they appropriate? We think we've got a decent level of exposure, but it is one of those barometers that we look at that tell us that the underlying economy, at least what the market thinks of it, is actually very positive.
Then I'm going to direct this question to you, Noah. This is something that I guess we've been fortunate, not just with having good markets in the past couple of years and great portfolio management, thoughtful investments. Should our clients, should all of us as investors be reconsidering our expectations for the next 12 months, 24 months?
Yeah, it's a really good question, Sarah. And I think that's something that we always as investors need to keep in mind, is making sure that what we expect from our portfolios and our investments matches up to the reality of what's possible, and not just what's possible in the broad marketplace, but what's possible for our own portfolios and the level of risk that we're taking on. And as we like to say here, there's some times in the market cycle where it makes a lot of sense to take on more risk because you're really getting rewarded for that extra risk. And there's some times where it makes sense to get really defensive because you're not getting rewarded for that extra risk. And I think right now we would say that we're at a bit of a neutral point to a slightly positive. We actually think the return potential over the next 12 months is fairly possible, but we are encouraging clients to start to caution expectations as we go forward, for the very simple reason that market performance over the last 2 and a bit years has been very strong. Double digits across the board in Canada and the US, and double digits internationally last year. And it's really not common to expect that level of performance for a sustained period of time. Markets always go in cycles, and they have periods of underperformance and overperformance. And since we've come out of this really strong market over the last year and a half, doesn't mean that it's going to be a negative year or there's not going to be great potential to make money going forward. But we are just reminding ourselves and reminding many of our clients when we have these conversations that expecting high teen performance or double digit performance is not the norm in financial markets. And that's when looking back at history is really useful. If you look at just a 100% equity portfolio in the S&P 500, which has been the best performing asset class over time, you would annualize kind of between 9 to 11% is is what you should expect over time. And we've been at the S&P 500 well over that for the last few years. So that just naturally means that future performance is likely going to be a little bit lower. So I think always recalibrating to the historical norm is important, because over time, that is what we should expect. In the equity markets, 9 to 11%, and for different asset classes, it'll be a little bit lower. So depending on your particular portfolio allocation, it might look a little bit different over the next 2 years than it did the past 2 years.
Okay, well, this hasn't been our normal, if you will, market outlook, and we apologize again for the technical glitches that we had. But typically we would have a Q&A here at this point in our talk, and we haven't had the same number of questions, but I did have a few that perpetually get asked. It's always an ongoing thing. Himalaya, the Canada-US dollar. Can you shed some light on what's happened to it recently, and that's certainly been in the news?
Sure. So we, ever since the new administration took over, we saw that big initial drop below 70 cents for the Canadian dollar. From that point, there were some that were saying, well, the next stop is going to be 60 cents. We were of the view that it would get back into the mid 70 cent range. When you look historically and you look at the fundamentals, 70 to 80 is the normal trading range for the Canadian dollar. We're sitting here at roughly 74 cents. So we have seen over the past 12 months, after that initial drop, we have seen the Canadian dollar appreciate quite a bit. I think we're getting pretty close to fair value. If it gets into the 75, 76 cent range, I wouldn't expect it to continue to rise much further. Ultimately, the currencies fluctuate based, they're another asset class. It's the outlook of the underlying economy that they are being priced off of. So what we have seen, as I was talking earlier about gold, there has been this movement away from U.S. bonds, U.S. dollar as foreign reserves. A lot of that has already worked its way through the system. So I would be, cautious about extrapolating what we have seen over the past 12 months. I think, the U.S. dollar versus most global currencies has made a fairly big move already downward. I would not expect it to move significantly further from here.
Thanks, Himalaya. And Noah, the other question we get all the time is interest rates.
Yeah, it's a really, really common one, especially given what we've been through over the last several years with the really steep rise in interest rates in 2022 and on, and then the gradual cutting that we've experienced. We've settled in at a place in Canada where it doesn't look like there'll be many more interest rate cuts over the next few years, and even some risk of potential interest rate increases if you look out 2 to 3 years from now. But I think it's safe to say that we're at a pretty stable level in Canada, and people shouldn't anticipate any major fluctuation one way or the other. That's at least what the markets are predicting, what the Bank of Canada is saying. In the US, it's a bit of a different story. Canada cut much faster than the US did, and so the US is in a little bit of catch-up mode right now, where they still likely have some more room to cut. We didn't get a chance to talk about it today, but the new Federal Reserve chairman nominee in the US looks like he will probably continue a similar stance as Jerome Powell, where they'll cut where appropriate, but he's not going to be overly quick to cut, contrary to what the president maybe thought when he decided to put him forward for the appointment. So we expect in the U.S. to see some gradual cutting there, which will be very supportive for markets and businesses in general. But we're really not predicting any major change in interest rates in either countries, unless we see inflation spike again, which currently right now is not something that we think is going to happen.
Yeah, I think I had discussed inflation just briefly, and to continue what Noah was saying, the outlook for inflation, inflation has tended to be more backward looking as far as topics go, and central bankers are very prone to what I would call recency bias. They're looking at inflation and where it's been over the past few years, and they're very vigilant about that. But and not enough of them are forward-looking because they've been burned in the past about making forward-looking projections. But when we look at what makes up the inflation basket, the consumer price index, real estate and the cost of home ownership or rents, that forms the biggest chunk of that inflation basket. In the U.S., it's somewhere between 35 and 40%, something a little bit lower in Canada, but very significant. And there's always been a lag between just the way to calculate that component within the inflation statistics. But when we look at home prices, we all know in Canada and specifically in Toronto, home prices have been declining. Rents have actually been coming down. And the same situation has been in the US, where home prices have actually been coming down, rents are falling. So it is expected that in the back half of this year, you will start to see the impact of lower real estate prices start to filter into that inflation number. So we may see some inflationary pressures on the goods side or on some other services, but the 800-pound gorilla of the CPI basket is actually going to start to trend lower. And that inflation worry that a lot of people are talking about may actually go the other way. And we may actually start to see that disinflation, which would allow the Federal Reserve to cut 2 times, maybe 3 times this year.
It'll be interesting to see how sentiment changes south of the border then. Well, I think that this, unless either of you, my esteemed colleagues, have anything else that you'd like to add, I think we should wrap our first market outlook for 2026 up. Maybe pass it back to our fearless leader.
My first takeaways and the stuff that I could hear were actually, the US dollar is going down, interest rates are coming down, the markets are going up, and AI is going to help us. So I think there's a whole bunch of factors that are going to, probably at the end of the year, it's going to be good. But during the year, we're going to have a little volatility. And, and that's probably to be expected given the first month, what you've seen in volatility. So I think that what I like about our portfolio and the way that Himalaya and Noah and Sarah are managing it is the fact that, it's diversified. So we've got a few losers in the group, but what I really like is actually we always have a couple of winners. And it's always that sort of yin and yang that make a portfolio do well. It's impossible to always have winners. And so I think that the fact you're diversified reduces your risk and it makes you sleep at night. I think you guys are doing a great job. Thanks for last year, Himalaya, and the team. You guys did fantastic. And then going forward, I know it's going to be hard, but I'm actually really excited because I think this AI thing is going to be something that will make a little bit more money, and companies are going to do well. But it's going to be really interesting to see how it plays out. So thanks, everybody. So sorry for the disruption in the technology. We'll get that fixed for next time. But it's been a pleasure, seeing everybody in 2025, and I look forward to seeing everybody in 2026. Thanks a lot, and stay warm because it's cold.